ever pondered the right time to buy and sell stocks in the stock market? It's a question that intrigues novices and experts alike. Investors around the world constantly seek the magic formula that can predict the rise and fall of stock prices. With the complexities of the stock market and the volatility of global economies, one could wonder, is there a method to the madness? If you've ever found yourself asking these questions, then you're undoubtedly in the right place. Welcome to our world where we seek to demystify the stock market, where we attempt to understand the unpredictable nature of stocks, and where we aim to navigate the nebulous realm of investments. Here we talk about not just the how, but also the why behind every rise and fall in stock prices. We strive to empower you, the investor, with the knowledge and tools necessary to make informed decisions, to be the master of your financial destiny. Now, you must be wondering, what could possibly be the answer to your questions? The answer, my dear friend, is swing term might sound complex, even intimidating to the uninitiated. But fear not, we've got you covered. Swing trading is a fundamental trading method used by traders worldwide. It leverages the natural swing of the market's prices. This strategy involves holding stocks or securities for a short period, usually a few days or weeks, with the aim to capitalize on short-term price fluctuations. It's a potent tool in the arsenal of traders, an elixir enhance your trading efficiency. But wait, let's not rush into things. Let's take a step back and gradually unravel this concept. After all, we're here to learn, to grow, to become better traders. So, what exactly is swing trading? Why is it important? How does it work? What are the benefits and risks involved? And most importantly, how can you, as an investor, effectively apply it to your trading strategy? We will explore these questions and more over the course of this discussion. We'll delve history of swing trading, its evolution, and its current relevance in the dynamic world of the stock market. We'll examine the key principles that guide swing trading, the strategies and techniques employed by successful traders, and the common pitfalls to avoid. Further, we'll take a closer look at the technical analysis, chart patterns, and indicators used in swing trading. We'll discuss how to identify the right stocks for swing trading, how to enter and exit trades, and how to manage your risk. We'll also share some practical tips and tricks to improve your swing trading skills and enhance your trading performance. Our objective is simple: to make swing trading understandable, accessible, and beneficial to all. Whether you're a beginner dipping your toes in the stock market or an experienced trader seeking to diversify your trading strategies, we're here for you. With patience, practice, and persistence, you can master the art of swing trading and potentially reap substantial profits. So, are you ready to embark on this exciting journey with us? Are you prepared to unlock new possibilities, to conquer the challenges, to turn odds in your favor? If you are, then let's begin. Remember, it's not about the destination, but the journey that matters. Let's learn together, grow together, and succeed together. Today, we'll break down this strategy step by step in a manner easy enough for everyone to grasp. Firstly, what is swing trading? It's a style of trading that attempts to capture short to medium-term gains in a stock or financial instrument over a period of a few days to several weeks. Swing traders primarily use technical analysis to look for trading opportunities. These traders may utilize fundamental analysis in addition to analyzing price trends and patterns. Step 1 is identifying a trading opportunity. This involves studying the market trends and looking out for stocks that are trending up or down. The key here is to pick a stock that is likely to make a significant move in the near future. The second step is market timing. This involves identifying the right time to enter and exit the market. Swing traders often use technical indicators like the Relative Strength Index, RSI, or Moving Average Convergence Divergence, MACD, to time their trades. For instance, if a stock's RSI crosses below 30, it may indicate an oversold condition and a potential buying opportunity. Step 3 is risk management. Traders must always have a plan for managing their risk. This could involve setting stop-loss orders to limit potential losses or using position sizing to control the amount of risk on each trade. Remember, even the most successful traders have losing trades. The goal is not to avoid losses, but to manage them effectively. The fourth and final step is trade execution. This involves actually placing your trades. Swing traders typically use a combination of limit orders and stop orders to manage their trades and protect their profits. To summarize, swing trading involves 4 key steps: identifying a trading opportunity, market timing, risk management, and trade execution. It's a style of trading that attempts to capture short to medium-term gains in a stock or financial instrument. Bear in mind, while swing trading can be profitable, it also comes with its fair share of risks. It requires a significant amount of time and effort to study market trends and identify trading opportunities. Moreover, even with the best strategies, there's always the risk of losing money due to market volatility. In conclusion, swing trading is not a get-rich-quick scheme. It's a disciplined approach to trading that requires patience, risk management, and a solid understanding of market trends. So, the next time you wonder when to buy and sell stocks, consider swing trading and remember the 4 key steps we discussed today. Happy trading!